step forward. Again, I graduated from IU. I'm just kidding. I'm just giving him a hard time. Okay, so today we are going to cover a little bit of budget basics. I don't want to overlap because I know you just had a previous session on kind of the basics of budgeting. We overlap just a little bit. I'm going to go a little bit quicker through my slides because I don't want to bore you. But I do want to hit on a couple points because sometimes it's good to hear it a couple times for it to sink in, to know what it means. So I will hit on a couple things. But where I want to spend a lot of time today is on the 1782 notice. Hopefully you all know what that is. If you don't, you will know what it is after this class. There's not many classes, at least that I have found, that cover the 1782 notice, what all those numbers mean. Really, if we had 8 hours, we could really get into depth on the 1782, and I don't have 8 hours. So I'm going to briefly go through it, but I hope it gives you a better understanding of what that is. So we'll go ahead and start. So again, I'm going to cover a little bit budget basics, 1782 notice, talk a little bit about how to estimate revenues because we should start that process now, and why it's important to estimate your revenues first before you prepare your expenditure plans. And then Jason's going to talk about some funding options, and then he may jump in here and there, especially when we talk about circuit breakers. So what is a budget? Why do we budget? It's not just an administrative task that is required by the state. It is that, yes, but it's not just that. It's a management tool that we can use to ensure that our resources, namely property tax, are allocated appropriately to the services that we provide. It's also a financial plan. And I really encourage all of you to prepare expense budgets that are as accurate as possible. I still hear this myth, this common misconception that we have to budget high in order to get the maximum levy. That is a complete misconception. You can budget $1 and still get your maximum property tax levy provided that you fill out your budget forms appropriately. So I encourage you to prepare a very accurate budget, because that helps you to better manage the finances going out into the year. It's a resource for county officials to identify to the taxpayers what the goals and priorities are of the county. And it's also, most importantly, it's a tool that helps you to get approval to spend your money, because you're a governmental agency or a governmental entity. You have to have permission to spend the money that you have in the bank. And that's what we call an appropriation. And part of this process is to get that spending authority. So quickly, the budget process starts really at the county. The county will assess the property all throughout the county. We're on a cyclical reassessment now, so it doesn't happen all in 1 year, but that's how we get the tax base. We need to have the value of all real and personal property in the county. At the same time, local government is preparing their budgets. You know, what are you going to spend next year? What's the estimated tax rate? What's the estimated levy? All of that funnels down to the Department of Local Government Finance in Indianapolis. When you submit your budget on Gateway, they receive that information. After they receive that information, then they review it, make sure you followed the statute, and make sure that you can fund your budgets within those maximum levy limitations. Once they do that, they can certify the tax rates. Well, that is what the county needs in order to prepare your tax bills. So they prepare the tax bills, send them out. People pay their taxes, hopefully, on May 10th and November 10th. Once all the taxes come in, it's then distributed out to the counties, or I'm sorry, out to the taxing units in June and December. So, you know, we always talk about cash reserves and why it's so important. Well, your major revenue source only comes to you twice a year, in June and December. So you can imagine at home, if you only got 2 paychecks a year, it would be very difficult to manage your bills and your mortgages and your car payments if you're only getting paid twice a year. So you have to have those cash reserves to help you through the times when you're not getting property tax. So there's 3 main sources of revenue, and again, I know you already covered some of this in the previous session, but taxes, property tax is the primary revenue source here in the state of Indiana, but comes second after that is probably local income tax. and that's the income tax you pay on your adjusted gross income. So when you prepare your Indiana tax return, you are likely paying a rate, because now every county in the state has some rate for local income tax. Another group of revenues is the other state distributed. So that would be like motor vehicle, highway, local road and street, wheel tax, should you have that, riverboat wagering. And then there's all kinds of local receipts, and that's just what you're generating. It could be building permits, licenses, ordinance violations, various things, court fees. Those are all locally generated receipts. Now, I know you covered this morning, but I just want to reiterate that net assessed value is our tax base. It's not the gross assessed value. So when we talk net assessed value, we are talking about the gross assessed value minus any deductions or abatements. So this is just an example, and I like this example because this is something sometimes the taxpayers don't really understand. If I have a $100,000 home value, that's not the value that I'm paying taxes on if it's a residential homestead. Here in the state of Indiana, we get $45,000 homestead deduction. I think if your value is over $60,000, but in this case, if it's $100,000, you get a deduction right off the bat of $45,000. Then on top of that, you get a 35% supplemental deduction, and then you could also get a mortgage deduction. So after all that's said and done, on a $100,000 residential homestead, I'm only paying taxes on about $33,000. So, you know, when you're in a council meeting and maybe the council is talking about increasing the rate, maybe on their CCD fund, their Cum Capital Development Fund, and somebody in the audience is trying to calculate that 2-cent rate increase based on their $100,000 home value. It doesn't work that way. You have to take off the deductions first, and we see that it's a lot less then. So net assessed value, that's what our tax base is. Property tax levy, again, another term that you heard at the earlier session. I just wanted to show you a calculation. So we start with our net assessed value. So let's say that your county's net assessed value is $442.5 million. If I'm trying to figure out what a tax rate of 0.4068 would generate, all I would have to do is take that tax base, divide it by 100, and apply it to the tax rate. So in this case, 40 cents, we'll round it up to 41 cents, will generate about 1.8 million on a tax base of 442.5 million. So that's how that works. It's a specific formula. And when you're preparing your budgets, you don't have to calculate the tax rate. I thought I heard in the previous session, use Gateway. It is your friend. Gateway will calculate the tax rate for you. You should not have to worry about doing that. So all you need to do is come up with a property tax levy estimate, and from there, let Gateway do the work for you. Maximum levy, I know you already heard about that. It is based on a growth factor. I think it's important to note that all taxing units in the state get the same growth factor. It's not based on how much your population is growing. It's not based on how much your property values are growing or how much you're spending even. Everyone gets the same amount of growth, and that's why you see some areas that are in rapidly growing areas like Hamilton County, for example. Sometimes they struggle because they may have a huge amount of growth and a huge amount of expenditures going out, but yet they're getting the same growth as everyone else, like 3.4% or 3.5%, whatever it may be. So again, it's just based on something that was determined back in the 1970s, and it's been growing by a small growth factor every year. And I know earlier you also heard about the difference between controlled levies and non-controlled levies. So the controlled levies are within that maximum levy limitation. So in this example, if we have a maximum levy of $1 million, there are certain funds that would fall under that $1 million. What you need to know is that the council, you and the council, have the ability to allocate that maximum levy among your funds. Now, there are some rate-driven funds, so there's some restrictions there, like Cume Bridge has a maximum rate, for instance. But when you're preparing your budget, let's say, for instance, You need $300,000 in the reassessment fund, and so you're going to reduce general by $100,000 and increase reassessment by $100,000. You can make those shifts during the budget time. Once the levies are certified, you can't make any changes after that point. And I know that sometimes DLGF, when they work your budgets, they tend to put most of the levy in general and then just kind of spread it out to the other funds. They're not really thinking about your expenditure plans. They don't know what you need the money for. They don't know if you're saving up for anything. So it's important that you understand that you have that ability during the time when you prepare your budgets to allocate that levy in the way that you see fit. You can also levy property taxes above and beyond the maximum levy, but it's very limited. So one way you can do that is to have a cumulative capital development fund. And most counties in the state do have this fund. If you are in a county that only has edit, then your maximum rate is 4 cents. All other counties that have Cadgett and Coat, or the previous Cadgett and Coat, your maximum rate, I'm sorry, that is wrong. Let me start over. The maximum rate for Cadgett and Coat counties is 3 cents, 0.0333, and for those that only have edit, your maximum rate is 0.0233. So, you know, you could have established at the max at one point, and it's come down over the years because the statute has the DLGF make an adjustment. If your assessed value goes up, that rate's going to come down so that the levy remains constant. So what that tells me is if you don't have a CCD fund, that's a good opportunity. You might want to look into that because that's additional levy that you currently don't have. You have to adopt it, though, by April 30th, so the time window has passed for taxes payable 2020, but you could do it next year. Or if your rate is much lower than the 0.033, then you could reestablish to generate additional dollars. The drawbacks of that is, yes, it's a tax rate increase, and it could increase your circuit breaker credits. But if you need additional monies for capital outlays, that may be a way to generate some additional dollars. You can also issue debt, like a general obligation bond, and have a debt service levy to repay that bond. So again, that would be additional monies above and beyond your maximum levy limit. Circuit breaker, and I did see where you covered that earlier, but I really think it's a good idea to get more in depth on circuit breaker. Some counties are substantially impacted by circuit breaker credits. So again, we've got these limits here in the state of Indiana based on your property type. So if you have a residential homestead, your tax bill is limited to 1% of the gross assessed value. Other residential and farmland limited to 2%, and other real and personal property limited to 3%. Now, if you're in a place that has a referendum, let's say a school put on the ballot for you to vote for a project, and it passed, you passed it, then you might pay above those percentages to some certain extent. But all in all, as a taxpayer, this is great. We're limited to the amount that we can pay. But as a taxing unit, we are seeing less property tax dollars to fund our services. Because if I'm getting a credit and I'm not paying it, you're not receiving it as a taxing unit. So again, some counties are impacted more than others. So how property tax caps work is that once the DLGF certifies a tax rate, the county will calculate your tax bill. So when they calculate the tax bill, should the bill be above that cap, they're going to issue a credit to you. So let's say that they calculate my tax bill. I have a $100,000 home value. They calculate my tax bill, and it comes out to be $1,200. But I can only pay $1,000. So they are going to issue a $200 credit that I'm not going to pay. So essentially, it's property taxes that were levied, but they're not going to be collected because of those credits. And that credit is a direct reduction to what you would have received in property tax dollars. If we didn't have circuit breakers, you'd get the full amount that you levy. But because we have circuit breakers, you could be impacted by that. I will tell you that the actual amount of circuit breaker loss is not known until the counties calculate the tax bills. So just recently in April, we now have the 2019 circuit breaker credits. They are located on the DLGF website. I encourage you to go out there and find those circuit breaker credits, because when DLGF worked your budget, they used an estimate. And their estimates over the past 2 years have tended to be quite high. I mean, they're trying to be conservative, so they're erroring on the high side. Please go and look, because I don't want you to be surprised that maybe the actual is coming in even higher than DLGF, because if that's the case, then you may have to make a budget adjustment. Hopefully you go out there and look and it'll be lower. But please go out there and see what your 2019 circuit breaker tax caps are. They are located on the DLGF website. Now, there are various factors that can influence the outcome of these circuit breaker losses, and that's what I'm going to turn it over to Jason for just a few minutes to cover some things that can impact the way that the outcome of those circuit breaker losses.
Thanks, Paige. Yeah, as I was listening to Paige's bio, I was surprised to hear that she went to Ball State, because I didn't know that, and I thought, well, it could be possible, because she would have been there about maybe 10 or 12 years before me, so I wouldn't have. So as Paige said, you've kind of gone through the budget process, kind of what all the different variables that go into the budget process. We talked about tax rates, the maximum levy, how they can increase about 3.4% a year. We've talked about net assessed value, how that can impact the tax rate. We've talked about circuit breaker, how that can impact what you actually receive. So we kind of wanted to kind of bring that all together because it's important, because one of the questions is we're working with counties, and the question is, well, how can we project what we're going to receive for the next year so we can budget? And circuit breaker credits is a big variable. So we're going to bring all this together to kind of help you understand how they all fit together, and kind of help you as you're doing your budget this summer, and as you're getting information from the assessor's office and from other offices and entities, from professionals outside your office, that kind of will hopefully give you more information to make an informed decision. And one of the first things I wanted to talk about was the assessed value, how that changes every year. As you know, you have trending that occurs on an annual basis. 25% of the county gets trended each year. That can go up, that can go down, that impacts tax rates, which we'll talk about here shortly. But one of the things that we do know, or have a better idea of what's going to happen, not only for 2020, but going forward, is a change in agricultural land. In the last couple of years, we have seen that decrease. Based on the projections, we're going to see that continue to increase for the foreseeable future. Especially the rural counties, that is hitting you pretty hard as far as the percentage of assessed value that you're losing. And that's impacting your tax rates and then impacting your circuit breaker losses. And this schedule right here just shows kind of the history. Let's see. The history of the net assessed value per 1 acre of farmland. So you can see in 2010 is about 1,250. We had a gradual increase, which was nice, and we kind of all felt that in our total tax base of our units. And then you can see starting in 2017, that's when we started seeing a decrease in that assessed value. And that's when they changed the formula, the state changed the formula on how ag would be assessed. And you can see how that's continued to drop. In 2020, the assessed value per 1 acre of farmland is 1,560. So you can expect a continued decrease in your farmland for next year. So it's important that the other classifications, commercial property, homestead, try to make up that loss in assessed value from ag. And again, for future projections going out to 21, 22, and 23, we're projecting that assessed value to go down even further. One thing that I did want to mention is there was a mistake, I think, right there for 2017. It shows that number actually should be 261 million. There's an extra digit there, so I did catch that last night. But it does show, this is, I think, for Stark County, based upon the change in assessed value per 1 acre of farmland, how their assessed value in their farmland has decreased over the years. Again, for circuit breaker, as Paige mentioned and talked about circuit breaker losses, a big component of that is the tax base and the maximum levy. So here we were just kind of showing an illustration for Stark County. If their assessed value grew from 0 to 2.5% for about 3 years, and then after that grew from 1 to 2.5%, depending upon the classification, but their maximum levy grew by 2.5 to 3% per year, you can see, you can see how the circuit breaker losses are anticipated to increase drastically over that time period if these assumptions were to come to fruition. So the reason for that is what we're going to show in the next couple of schedules, kind of how, again, the assessed value, levies, and circuit breakers all work together to basically determine how much money you're actually going to receive each year. So this is an illustrative taxing unit. It's a city unit. So you can see the first column there, it's kind of all the different units that make up the taxing district. You have the county, the township, the city, school, library, and this one has an airport. It has the tax rates. Sorry about that. It has the tax base, so net assessed value. So this is the assessed value of all the taxpayers in the county. And then the levy, so the amount of budgets that are payable from property taxes. So if you look at the current situation, this county has a budget of $3.4 million, a tax base of $579 million. So it needs to levy a tax rate of 59 cents, almost 60 cents, to be able to fund that budget. So that's kind of year one. Year two, let's assume that your assessed value increases by 1% countywide, but your maximum levy increases by 3.4%. So now instead of having a budget of $3.4 million, you have a budget of $3.5 million. Your tax base has grown from $579 million to $585 million. But now instead of needing a 60-cent tax rate, you now need a 61-cent tax rate because your levy grew faster than your tax base. So we do that for all the different units. And this is kind of what DLGF does when you submit your assessed values to the state and to the budgets. This is kind of what they do to calculate your tax rates. So in year two, instead of have a tax rate of $3.55, you now have a tax rate of $3.63. So the tax rate's growing by about 8 cents, and in gross revenues, you're going to generate an extra $394,000 in revenue. And I say gross revenues because of circuit breaker losses. So in scenario one, the current situation, assuming you had $1 million facility, commercial facility, they're capped at the 3%. So even though if you take their your current tax rate of $3.55, their gross taxes are $35,000 because they're capped at the 3%, they're not going to pay more than $30,000. So they're going to receive a circuit breaker credit of $5,527. Again, that's great for the taxpayer, but as Paige said, that's $5,000 less that you and the other units are going to receive. So looking at year two, when you have that 8-cent tax rate increase, again, the taxpayer is not going to pay more than $30,000 again. What happens is their credit increases, now to $6,353. So what does that mean to the county? That circuit breaker is allocated proportionally based upon the tax rate of each individual unit. So in this situation, the county had 17% of the total tax rate of this entity. So 64 cents of the total $3.63. So the county is going to receive 17.7% of that credit. So that's $1,125 from this taxpayer that the county that you were anticipating to receive when you did your budget, but aren't going to receive. The second scenario we did was, again, kind of showing how important assessed value is, because I think that's something that I think local officials, it doesn't matter what office you're in, what elected official you are, I don't think some people realize how important all these variables play. For instance, assessed value, we talked about tax abatement, how important it is to increase your tax base and keep that maintaining at a higher level than your gross assessed value. Again, we kind of show you how important assessed value is. In this situation, same scenarios, except having a 1% increase in your assessed value countywide, you have a 5% increase in your assessed value. Still assuming that your maximum levy only increases by the 3.4%, you can see the tax rate decreases by 5 cents, going from $3.55 now to $3.49. And that's just because your assessed value is growing faster than your maximum levy. So because of a decrease in tax rate, now the circuit breaker losses are going to be less than what you had the previous year. So for that same taxpayer, again, the assessed value, $1 million, capped at $30,000. They had a $5,000 circuit breaker loss in year one. In year two, that's gone down to $4,900. So that's really more money that you'd have seen from the previous year. So again, it's very important that your assessed value, it's kind of gold. You want your assessed value to keep increasing. That's why it's important for the assessors to assess property correctly. That's why it's important to only give tax abatement. I'm all about economic, and I'm all about TIF, and I'm all about incentivizing companies to locate there to your facility. But only offer them what you need to get them there and no more, because you want that assessed value to help keep tax rates down and help reduce circuit breaker losses. And then kind of the, this page shows how that $4,997 circuit breaker is allocated against the counties. Again, the county receives about 17.7% of that loss. And then the next scenario, kind of the other extreme, what if assessed value decreases by 5%? So this is important because there are some communities out there where I've worked with where you've had a large employer move. So if they've moved all their equipment out of their facility, if their building's now being depreciated at a much greater percentage than it was before because it's now vacant, you could maybe anticipate a larger decrease in your assessed value. So as you're putting together your budget, and as Paige mentioned, there's estimates on DLGF about circuit breaker losses, but if you know your assessed value is going down, you might, when you're budgeting, may assume that your circuit breaker losses may increase more than normal because you know ahead of time that your net assessed value is probably going to go down. So in this case, this is a pretty drastic decrease, but if assessed value went down by 5% in this county, again, keep the maximum levy the same at 3.4%, the tax rate would go up 30 cents from $3.55 to $3.86. So by the tax rate going up 30 cents for this $1 million taxpayer, their circuit breaker losses or circuit breaker credit would increase from $5,500 to $8,600. And then the circuit breaker loss to the county would now be $1,520 that they would not receive. So again, this was just kind of to show you how the assessed value, maximum levy, and circuit breaker kind of work together and really impact the amount of revenues that you receive the following year.
Thanks, Jason. So I think the bottom line here really is there's a lot of different factors that go into circuit breakers. The rates, how quickly are the tax rates increasing? The tax base, is it going up or down? The levies are pretty constant. I mean, we know we're only going to get maybe a 3.4 to 3.5% growth on the levy. So really, there's a lot of different factors involved there. So the next topic is the 1782 notice. So I'm going to walk you through most of the pages of the 1782 notice. Again, this could be a class all by itself, which I have taught a class like this all by itself, and it took about 3 hours, and we really dissect this thing all the way down to the last number. But we don't really have time to do that today. So again, I'm just going to kind of walk you through each of the pages just so you understand what it's showing you. So this is the very first page, and it is important, even though it has a lot of different words on it. It's got some statutory language, but the most important thing about the first page of the 1782 notice is the due date. This one just happens to be due back to the DLGF by December the 7th. So what happens is the DLGF will, after they work your budget and make sure you follow the statute and they put together some preliminary numbers, they put it on the 1782 notice and they will email it out to you. That's the only method of receipt nowadays of the 1782 notice. So when you go into Gateway, one of the forms is called 1782 Recipients. Please make sure you have at least 2 email addresses in there because you could be out on vacation, you could be out sick, it could be the holidays. You want to make sure that somebody gets the 1782 notice because you only have 10 calendar days to review the 1782 notice and respond. So you're probably thinking, well, what's my response going to be? Well, you could find that the DLGF made an error. I mean, we all make mistakes. We occasionally find errors ourselves, and some of them can be pretty big errors. Well, you want to be able to catch that and notify DLGF that they've missed something, or there's an error or some transposition of a number or something. But you can also request a shift of levies, provided that you advertise high enough. When I say advertise, I mean posting on Gateway. We no longer advertise in the newspaper, but providing that you advertise the notice high enough, you might be able to make a shift, like put some more levy in reassessment and less in general. Because again, when the field reps work your budget, they're just kind of guessing at how much levy needs to go in each fund. When you get the 1782 notice, you can rearrange those levies. As long as you're high enough on your budget form 4Bs, you can do that. And there could be some other changes. If, let's say, DLGF cut your budget, but you can prove that you have more revenue than what you had originally submitted in the budget, you might be able to get your budget reinstated. So you've got 10 days to kind of look at all of that and review it and go back to the DLGF with a response. So that's the first page, very important. That due date is pretty much set in stone. I've not seen DLGF take anything after this due date. So that's why, again, it's very important. You have 10 calendar days. You could get this on December 23rd. Well, then we're off on Christmas break, right? That doesn't matter. I mean, you got to follow the due date. The next page is, I'm just going to say this. I think all these pages are somewhat confusing. If I had not worked at the DLGF previously in my previous lifetime, I would struggle with some of this because it's not explained very well, quite frankly. This next page is actually showing you your budget, your expenditures, your appropriations. It doesn't have anything to do with your property tax levy. Although it mentions the levy in here, this page has nothing to do with the levy. So what you're looking at is your approved appropriation. So it'll say budget approved for displayed amount. That means that DLGF approved what your council adopted. So that's a good thing. So whenever I'm reviewing the 1782 notice, I just scan through here to make sure that all my budgets were approved. I don't care when it says rate reduced to remain within statutory levy limitation. I know what that means. It means that I used a conservative assessed value to prepare my budget, which is recommended, and my assessed value in actuality was a lot higher, so therefore the DLGF reduced the tax rate. That's what they're supposed to do. That's not a red flag to me. So I pretty much ignore that. I'm just looking at the budgets. So all of these budgets were approved. It might say budget reduced due to insufficient funding. Well, that's because you submitted a budget that cannot be funded based on what you provided to DLGF. It could say that it was denied because you didn't submit your annual financial report in a timely manner. That's a possibility. So there's different things that it could say on here, but if you just want to see if all your budgets were approved, your appropriations, this is a good place to look. Now, look at all of these numbers just thrown on this page. There's actually 6 different funds shown on this page. It's really hard to tell what is what. What I'm going to do, because this is such a tiny print, is my very next slide is going to focus on just one single fund so we can really take a look at what all these line items mean. And I like to break this up into different categories. That's why I've colored them. I've kind of color-coded the different sections because each of these sections means something. So this is Fund 101. I don't know why they don't just put the fund name up there with the fund number. Wouldn't that make it easy? But they don't. So I know where you can find the fund name, though. That'll be the next page that we talk about. But anyway, Fund 101, I know that's general. So at the very top is the assessed value. That is your net assessed value. That is what was certified by the county, not necessarily what you put into Gateway, because I think what you heard in the previous session is you want to be conservative on that assessed value in Gateway. So we usually use about 80% of current certified assessed value to be very conservative. I know sometimes DLGF we use 90 to 95%. I don't think that's quite as conservative or conservative enough. I usually use 80%. But what you're going to see when you get the 1782 is the certified assessed value. That's it. So hopefully it comes in a lot higher than what you use for budget purposes. The next blue section is expenses for an 18-month period. Remember that here in the state, Our budgets are based on an 18-month period, so it's going to cover the last half of this year, from July through December, and then all of 2020. So that whole section is for the 18-month period. Line 1A, I completely ignore. It makes absolutely no sense, and I've told DLGF that. I don't have anything against the DLGF, by the way. I used to work there. I don't, line 1A makes no sense. I know what it is, how they got to it, but still, it makes no sense. It includes circuit breaker, and circuit breaker is not an expenditure. It is a reduction of revenue. It should not be on the budget form 1. It is not an expenditure. Okay, so I'll get off my soapbox. Line 1B is the DLGF's estimate of circuit breakers. Okay, so they stuck that on line 1B. That's their estimate. But if you pick up your 2019-1782 notice, this is what I want you to check. I want you to get your 2019-1782 notice and compare it to the real circuit breakers that are sitting out there on the DLGF website right now. And what I'm hoping you find is that the real ones are less than what DLGF originally estimated. If they are more, you may need to make a reduction in your budget because you're not going to get as much property tax as originally anticipated. Line 1C is your certified appropriations. That used to be just line 1, certified appropriations. Now it's kind of lost in this 1A, B, C thing. So 1C is the budget that was adopted by the council and hopefully ultimately approved by DLGF. Line 1D doesn't have anything to do with you. That's for schools. Line 2 is what are you going to spend the last half of this year? We're looking at a 2019-1782 notice, so that would have been the last half of 2018, but it's covering the last half of the year. Line 3, what additional appropriations do you anticipate the last half of this year? And then if there's any temporary loans that need to be repaid to another fund, you're going to put those in on line 4A and B. So if we total all of those up, what line 5 is telling us is that we have about $31.1 million of expenses for this 18-month period. Now let's go to the next section. That pink section is cash and receipts for the 18-month period. So we start with a real number. It's June 30th cash, so we don't have that yet, but once we close out our books for June, we'll have the actual June 30th cash balance. Line 7 is what is the anticipated December property tax settlement. So what you can do is take your total certified levy for 2019, subtract out the estimated circuit breakers, and then subtract out what you received in June, and you should have a resulting levy then for December. That'll be a conservative estimate. Line 8A is receipts for the last half of this year. Line 8B is receipts for all of 2020. So we get down to line 9, and we've got total cash and receipts for an 18-month period. Okay, so we've got our expenses, we've got our receipts. Now, how much money do we need to raise then in property tax? If I have $31.1 million of expenses but only $26.85 in receipts, I need to have additional monies to fund my budget. And in this case, on line 10, that amount is $4.2 million. So that's what I need to fund this budget. But I am allowed to have a maximum levy that's greater than that. So my levy that I'm allowed to have in this general fund is $7,678,000 in this example. So if I'm going to raise $7,678,000 and I need $4,257,000 to fund my budget, I subtract that out, then what I have left over is a cash reserve of $3.4 million. That's on line 11. So that cash reserve is supposed to reflect the estimated ending cash for 2019. Now, that may or may not happen depending on if you get all the receipts that you anticipate. If circuit breaker's higher, that may not happen, but that's what that is supposed to reflect, estimated ending cash for, in this example, 2019. Then the tax rate is just a calculation. It's basically taking the levy of $7,678,000 divided by the assessed value divided by 100, and that's how we get to the tax rate. So that tax rate on the 1782 notice should actually be lower than when you prepared the budget in Gateway, because if we ask you to use a conservative assessed value, it's going to take a much higher tax rate to get to $7.7 million. So as the assessed value goes up, the tax rate comes down to get that levy that you need. So hopefully the outcome on the 1782 is much better. So then we go on to the next page. Again, I can't really see this. There's a bunch of numbers on here, so I'm going to focus in just on the bottom of the page. I really like this last page of the fund report, especially at the bottom, because it does summarize a lot of good information for us. So finally, we get to see the fund numbers along with the fund names. That's convenient. We also have the assessed values for all of the funds. We have the certified tax rates for each of the funds. And we have the tax levies. There's also a column CNTRL, control. It's abbreviated for controlled levies. If it says UT, it is a controlled levy, meaning it's within the maximum levy, with one exception. The CUME Capital Development Fund is not a controlled levy fund. I don't know why it's marked UT. It should not be, but it is. The CUME Capital Development Fund, you actually get an adjustment outside the normal maximum levy for that fund. So if you didn't have that fund, you wouldn't get the $1.7 million in this example. So that's the exception. But the other ones you can see, like general says it's UT. It's controlled. It's within the maximum levy. Health says UT. It's controlled within the maximum levy. Why that's important to you is that if it's a controlled fund, you can do those levy shifts during the budget process time if you need to. If one fund, health, needs more and you can get by with less in reassessment, you can make that shift. Something else to note on this is down towards the bottom, it shows you your normal maximum levy. And it also shows the adjustments that you get above and beyond that. So county units, not only do you get an adjustment for your CCD fund, but you also get an adjustment for mental health and mental disabilities. So in other words, if you weren't budgeting mental health and mental disabilities out of your general fund budget, you wouldn't get these adjustments. These are outside the levy limits. And then finally at the bottom, another important piece of information is, are you levying the full maximum levy? In this case, you can see that this county is under the maximum levy by $4,508. It's at the very bottom. That tells me that's just rounding, because DLGF cannot put you above the max, and if they're telling us that the maximum levy is $11,151,000, they can't even go a few dollars above that. So there's always going to be kind of a rounding factor. It's rare that I see where it says under the max by 0. That's very rare. I know it happens sometimes, but this is just a rounding issue. But that means that when DLGF calculates the 2020 maximum levy, they're going to add back that $4,508 because you're not permanently under the max. Now, if you look at this and it says $300,000 or $400,000 under the max, there's probably an issue. Maybe you deliberately wanted to be under the max to control your tax rate, or maybe it was a mistake. But to get back up to the max, you just need to make sure that you fill out your budget documents appropriately to get that full maximum levy. Another page of the 1782 notice is, it's really the budget form too. When you put in your revenues in Gateway, we call that a budget form too. Well, this is how it translates to the 1782 notice. This is your estimate of miscellaneous revenues for an 18-month period. But it's everything except property tax, because property tax doesn't go here. It goes on the budget form 4B, and I think those forms were covered in the previous section. But this is everything except property tax. And it really just looks like the budget form 2 in Gateway. Here is the miscellaneous changes report. So remember I said that you are getting certain adjustments that are above and beyond the maximum levy. Well, here's where you can see what those adjustments are. You saw a total on the previous couple slides, but here we can see the detail. So if you start up at the very top, mental health budget. The budget for this particular unit, what they put in their commissioner's budget was $404,500. The maximum allowed per the statute is only $404,488. It's only, what, $12. But that's all DLGF could give them. So if you look down the next line, it says total adjustment for this is $404,488. So basically, you can get the lesser of what you budget or the maximum allowed by statute. Developmental disabilities, the county's actually allowed about $1.7 million, but they choose to only budget $135,000, so that's all they're going to get above and beyond the maximum levy. They could, for 2020, prepare a developmental disabilities budget of $1.6 million, and they'll get the $1.6 million more in property tax, but it's going to increase their tax rate. So that's something that this county doesn't want to do. Developmental disabilities is fine with getting the $135,000. But that's, you just need to know where these adjustments are coming from. And then item number 3 is that cumulative fund adjustment. And that's really just what your current rate is times the net assessed value. So this county's getting an adjustment of about $1.7 million outside the levy limits. If you don't have a cum capital development fund, you're missing out on this adjustment. It's the only fund except for Major Bridge that's outside the levy limits for counties. So you would be missing out on this type of adjustment. And then if you do file a levy appeal, like a shortfall levy appeal, that would be listed on this form as well. So just some quick notes about estimating revenues and then preparing your expense budgets. So when we estimate revenues, we use a couple tools that are readily available to you. You can start estimating your revenues now. You don't have to wait for any information to come from the state. We'll gradually start getting that information and we can update our revenue estimates, but we're already preparing revenue estimates for 2020. So what we do is we usually pull 3 years of annual financial reports available on Gateway, very easy to access those. We definitely want the 2019-1782 notice in front of us. And then we also like to look at year-to-date receipts through the most recent month ended. And we kind of like to go through June 30th if that's available. But if you wanted to get a head start on it now, you could do it through April, the most recent month ended. So what we do is we do look at the 3-year average of revenues. Maybe not so much on property tax because we've got a formula for that. We just apply a growth rate. But on especially those locally generated receipts, and you can even do this for the state distributed, we want to see what kind of trends are happening. Sometimes there's not much of a trend. It's pretty flatline, so I can use a 3-year average. Other times it might be going up and down, so I still might want to do a 3-year average, or I might want to throw out the outliers. It becomes really clear once you put those numbers all together on a single page, which I'm going to show you an example. And you do want to capture any changes. Did the council increase the local income tax? If they did, we need to account for that potential increase in local income tax. Were there changes made to building permit fees? Any of those changes, you want to try to capture those changes. So what we tend to do in our office is any of these Gateway reports I love, you can download them to Excel. And so we basically just start with 2016 annual report, the revenue piece, and we just download that report to Excel. Very easy, it comes into a nice Excel document, and then I just paste in 2017 and 18 so that I can have a side-by-side comparison of the receipts for the last 3 years, and then I'll even throw in a column that has the 3-year average. This is very helpful because I can see if there's trends, I can see if there's outliers, and this really helps me figure out what my revenues are. Notice I'm not even using the budget, because a budget is only an estimate. I'm using actual numbers. That is really where we like to use the numbers. The budget, unless you're extremely good at budgeting, which I'm sure some of you are, it's really better to use actual results, what really happened. The circuit breaker tax caps can be a lot more difficult to estimate. Just as you heard Jason talk about, there's so many factors that affect that. But if you want to do just a really quick estimate, this is something that we do, but you might want to adjust it based on what you know is going on in the county. So here, I just pulled off, the box at the bottom is what I pulled off of the DLGF circuit breaker report. I just basically copied it into Excel. So this was for Boone County. So I was trying to figure out for the general fund how much circuit breaker is in Boone County's general fund. So the total circuit breaker is, if you look in the far right-hand column, is $313,543. So I was trying to figure out, okay, how much of a loss is that to their general fund levy? So it's a percentage of their levy lost. So $313,000 divided by the certified levy for that fund, which is also shown on this report in the, looks like the third or fourth column, is 7.7 million. So basically they are losing 4.1% of their levy to circuit breaker, or in other words, 4.1% of their levy is being returned to taxpayers in the form of credits. Well, that percentage is important to me because once I figure out what my 2020 property tax levy is going to be, I can multiply that by 4.1%, or maybe even better, to be more conservative, maybe I multiply it by 5%. Maybe I round it up to be more conservative. So how did I get my general fund levy? All I did was the estimated growth factor for 2020 right now is 3.4%. I don't know what it's going to be in reality, but right now we're estimating about 3.4%. I just took the levy for 2019 and increased it by 3.4%. That's a good rough estimate for where we're standing right now. Eventually, we will get that growth factor so we can make a better estimate. So we've covered revenues, and so all the revenues would be your property tax minus your circuit breaker. Don't forget to take that out. And then add in any miscellaneous revenue, and that would be your total estimated revenues for 2020. So once we have that information, now we can prepare our budgets. And we're really trying to convince people this is a better way to do it. Oftentimes, what are we doing? We're preparing the budgets first and trying to figure out how we're going to fund them. We need to reverse our thinking. Let's prepare the revenues first to see how much we have to spend, then prepare our expense budgets. So again, we always prepare revenues first, and we try to match the expenses with the revenue. So it's sort of like zero-based budgeting. Here's how much you have to spend, so now let's develop a budget based on that. Not, here's the 2019 budget, let's increase it by 2 or 3% and we're done. Well, what if the 2019 budget is out of balance? That's not going to do you any good. So, oh, I didn't even advance the slide. Okay. So here's just an example. Let's say that we went through this whole process for the general fund and we came up with estimated revenues of about let's just call it $15 million, $14.9 million. Okay, so that's how much we have to spend on the general fund. So often I'm asked, well, then how do you know how much each department gets of that? Well, there's a couple of different methods that you can use. One method we use is we again look at actual disbursements, not budgeted, but we looked at 2018 actual disbursements for each of these departments and figured out what those disbursements were as a percentage of the total general fund budget. So for instance, the Sheriff's Department in 2018 spent 46% of the total general fund budget. So therefore, they could be allocated 46% of the revenues for next year, for 2020. Now, you do want to take into consideration one-time capital expenditures, throw those out. We just want to look at recurring costs. So we're just going to assume that these are all recurring costs. So this is one method. You could now go to the Sheriff's Department and say, hey, we've run the revenue estimates. You have $6.9 million to spend. Develop your budget. Don't pick up 2019 budget. Just tell me what you need to spend and fit within that. Now, they can use 2019. They can use whatever happened in 18. But that's the whole point of this, because if each department actually did this, guess what? You'd have a balanced budget, because your budget would exactly match the receipts that you're bringing in. Now, I know this is easier said than done, probably perfect world scenario, but I'm just telling you, this is kind of the process that we would go through to assist someone in developing a budget. So how do you know if your 2019 budget is balanced? I think that's an important place to start, because if you're picking up 2019 budget and using that as a basis for your 2020 budget and it's not balanced, you're just going to get further and further behind, meaning you're using your cash reserves. There's a very easy way to determine if your budget is balanced, and it goes back to the 1782 notice. That little square there that's in white, I just copied and pasted it directly off of the 1782 notice, and this is for the general fund. So I picked up my line 8B, which is miscellaneous revenue, $4,168,000. I picked up my line 16 because that's my property tax levy for 2019. That's $2,451,000. Then I subtracted out the estimated circuit breaker tax caps. Now, when I prepared this, I didn't have 2019 actual that's sitting out there on the DLGF website. So I just, for purposes of this example, used line 1B. But if you're going to go home and do this or go back to your office and do this, please use the real circuit breaker that's out on the DLGF website. So that leaves me with total estimated annual receipts for 2019 of $6,265,000. But what's my budget? DLGF approved me to spend on line 1C $6,567,000. They were able to approve that because I have money sitting in the bank. You know, I can fund this budget if I really want to, and that's why DLGF approved it. But it's out of balance. What this is telling me is that you are outspending your annual receipts by $300,000. Your cash reserves are going to go down by $300,000 if you spend all of this. So then I have some people say, well, we're not going to spend all that. We never do. Well, then are you telling me you don't have an accurate budget, or you've got some contingency line items? And it's fine to have some contingency line items, but know that, okay, we're not going to spend X amount. It's just, for me, it's kind of hard to manage the budget if I have a bunch of contingencies, and we always, underspend our budget by 10%. Well, that's quite a bit. I'd rather see more like 95, 96, 97% expenditures. And I know people don't like to do additional appropriations, so that's another reason why you build in some contingencies. So it can be from one extreme to the other, but again, this is how you can easily tell if your budgets are balanced. So in this case, I would not be starting from $6,567,000 when I start working on the 2020 budget. No, I would be more like $6.3 million. So maybe I have to cut or find some other alternate revenue source. Here's just some quick examples of budgets that we encounter. We already showed you the general fund. It's at a deficit. Local road and street I don't get too excited about because local road and street usually doesn't cover recurring costs. We know we can't pay for personnel out of this. So typically it's supplies or one-time capital things. If you've got the money and you can spend it, I'm fine with it being out of balance. You just don't want to do it every single year because you will end up running out of money eventually. Motor vehicle highway, I see an opportunity. You could potentially increase your budget for 2020 because you have a better than balanced budget. You could maybe increase it by another $25,000. Parks is balanced in this case. And then CUME capital development, I see a lot of opportunity because you could potentially shift some capital that is currently in the general fund over to CUME capital development to help bridge that deficit there in the general. So this is helpful too to kind of see what's going on in each of your funds. Didn't take very much time to prepare, and it's all kind of condensed down. Your annual report, very good tool to use, and the 1782 notice, very good tools to use. And some quick options. Obviously, this is not a comprehensive list of options, but shifting appropriations, there are certain funds that can be used for anything, like edit, for example. Riverboat can be used for anything you might want to shift. Be careful shifting things to rainy day. I would only use rainy day fund in the case of an emergency because you're not getting a recurring revenue stream coming in to rainy day. So therefore, you're not going to want to put a recurring item in that fund. Deferring capital outlays, I'm seeing that all over the state, and sometimes that can be more expensive than anything else. If you continuously fix a truck that breaks down every year, you're just dumping a bunch of money in something that you really just need to get rid of and replace. But I know we don't have a whole lot of money for capital, so I talked about bond issues earlier. Some counties will do rolling bond issues, maybe a couple million every 3 or 4 or 5 years, to cover some of these capital expenses that can't be covered in the budget. And they can put on a debt service levy to pay for that bond issue. Be careful with raises. I see too many times counties putting in raises for their employees because, yes, we know they need them. And you can fund them this current year because you've got that money sitting in the bank, but your budget's already out of balance. So in year 3, 4, and 5, now you're struggling to cover those raises, and we're not going to take the raises away. We might have to start eliminating people at that point. So we talk a lot in our office about long-term comprehensive financial planning. Don't just look at one budget year. You need to look at the changes that you're making, the permanent changes where you're adding employees or increasing salaries. How is that going to affect the years to come? Can you cover that in the future years? And then look at other revenue sources, and that's what Jason's going to talk about. There's other sources. I talked about the Cum Capital Development Fund. If you don't have that, there's local income tax, but Jason's going to cover some of those revenue sources.
Thanks, Paige. Now, I'll only cover the other revenue sources if I need to, because I'm guessing all of your counties have balanced budgets. We don't need to talk about other revenues. Well, I'm guessing that's not true from some of the clients that we've seen and some of the stories that we've heard. So we did want to talk about some, or at least really just one other revenue that you do have your ability to change and increase. And really, the options are pretty limited for counties. The 4 that we listed here, the wheel tax, local income tax, bonds that the Paige mentioned, and then tax increment financing in some unique situations that can help provide revenue for counties depending upon what you're trying to fund. But the one that I wanted to talk about, and I think has the most flexibility and that we've seen used a lot more here in the last few years, and I think we will continue to see that because of the flexibility. Also because the legislators, they keep tweaking it every year, somewhat allowing it to be more flexible. There were some major laws being proposed that would drastically change how local income tax would be calculated in the future. So we kind of wanted to hit that for the remaining part of our presentation. But local income tax, as I think we mentioned on the earlier slide, it's basically a tax levied against the adjusted gross income on residents who live in your county. So as you're filling out your state return, you're calculating the income tax that you'll pay within your county. And it's also important to know you receive the income tax for those who live in your county. I know sometimes that's a misconception. Working a lot with economic development within counties, they think that it's where you work. It's not where you work, it's where you live. As far as the adopting bodies that can adopt or change income tax, it really depends upon the adopting body that adopted the first income tax for what we used to call Cadget counties. It's the county council. What we call COIT counties, those counties that adopted COIT, it's the county income tax council, which the county income tax council is made up of all the different fiscal bodies within your county. And it's their voting percentage is based upon the population. So the cities and towns and counties all have a vote on any changes that you make, and their percentage or how much value their vote is worth is based upon their population. So for instance, if the county has 50% of the population of all the other units, the county would have 50% of the vote for any changes that were made. And then Edit County, it's either based upon a county council or the local income tax council, whoever adopted the edit tax when it was first adopted. And I know I've done this presentation before, and I know many of you have heard, and I'm not going to go through all the history because the local income tax has changed in the last couple years. But I think this is a good slide that, as I mentioned, a lot of counties are looking at either increasing or changing the makeup of their local income tax. So I think this slide is good because it tells you what the maximum amounts are on each component. There's 3 different components of the local income tax now. Property tax relief, which has a combined maximum rate of 1.25%. The expenditure rate, which has a combined rate of 2.5. Except for Marion County can go up to 2.75, but for all the other 91 counties, they can go up to 2.5. And within that expenditure rate, you have 4 different buckets now. You have the certified shares, which would used to be your COIT or CAGIT, your public safety tax, your economic development, and now your correction and rehabilitation facility tax. So a combination of all of those, you can be any combination you want, but they can't go above that 2.5%. And then there's also special legislation, special statute that some counties have where they've adopted a special tax rate that's for a specific project. And most of those projects are related to jails or courthouses. So in the light green box, oops, let's see. The light green box is kind of the old income taxes that we may be familiar with, and then these new are the new kind of terminology that we have. But I've wanted to explain that all counties now, all 92 counties have a local income tax, and of the 92 counties, 85 have the property tax relief, and we'll kind of go in more detail about what each one of these are and how flexible they are. Of the 92 counties, 86 have certified shares, or what we used to call COIT or CAGIT. 66 have public safety, or 65, sorry. 74 have economic development. 10 have the correctional and rehabilitation facility, which was just, that just came into play 2 years ago, and already 10 counties have adopted that. And then 26 counties have special legislation for specific projects. So you can see that the range is pretty wide as far as what counties have, and most have multiple of these 3 different components. Not only are the components vary between counties, but also the various rates vary drastically between counties. So what this graph shows here is just kind of all 92 counties spread out from the highest rate to the lowest rate. And then it's kind of a bar graph that shows kind of compound on the various rates that they have. But Pulaski County, someone had to be the winner, and Pulaski County is the winner with the highest local income tax in the state of 3.38%. And I think it's Harrison County that has a tax rate of 0.35%, the lowest in the state. But as you can see, it's kind of all in between. So I just kind of wanted to hit about a little bit about each of the local income taxes, because each one is unique and depending upon your situation. And again, the reason we're talking about this is a potential new or additional revenue source that is kind of one of the tools that you have to help fund that gap in your budget. And the first one I want to talk about is property tax relief, local income tax. And this isn't really new revenue that you would receive, but as the name says, it's property tax relief. So what this tax would do is you're basically raising income taxes and then reducing the amount of property taxes, or reducing the amount of income tax, reducing the amount of taxes received from property taxes. So again, and the reason that you would do that is if you're a county that has a lot of circuit breaker losses because you have high tax rates, property tax rates, you can increase your income tax, then reduce your property taxes, which will reduce your circuit breaker losses. Those incomes that you receive from the property tax relief, local income tax, can be applied to different classifications of properties. So this is important. A lot of counties have property tax relief, and a lot of counties apply this uniformly. So basically all taxpayers get a benefit, which is nice and it's fair, but it may not be really helping you, because in most communities, homeowners aren't receiving the credit. So you're just reducing their property taxes where they're already below the credit. It's not really helping your situation because it's not reducing the circuit breaker losses, which is really what you need. I know there are a couple of counties out there that when these options first came available, they put the majority of their property tax relief on homesteads and gave very little to commercial properties. Well, as you know, in a lot of the cities and towns, especially cities where the tax rates tend to be higher, a lot of those commercial properties that's what's hitting the cap. That's what is hurting all the units and causing the amount of revenue you do receive to be decreased because of circuit breaker losses. Well, if you apply this credit to homesteads and not to commercial property, you're really not helping yourself. You're helping the homeowners because you're reducing their property taxes, but you're not really reducing any circuit breaker credits. So if you're looking at adopting this or increasing this rate, I strongly encourage look at your circuit breaker losses, see where the majority of them are coming from. Are they coming from the 1%, 2%, 3%? And then you can determine, do you want to apply this credit or this new income to homesteads, to the 2%, which is the rental property, or ag, or to the commercial property. And you can do the percentage in any combination of these classifications. And this is a study that we did for Vermilion County when they were looking at increasing their income tax. They were looking at increasing public safety. They were looking at increasing the property tax relief. So this is just a study that we did that showed that if they did nothing, if they kind of kept status quo, if they didn't increase their property tax relief, what their circuit breaker would look like. And that first bar graph there is, we're anticipating in 2018, their circuit breaker losses would be $427,000. 2019 would grow to $509,000. 220 would increase to $585,000. That's just what we projected based upon, again, assessed values kind of staying where they have historically and with maximum levies increasing. This is what we were projecting. So they asked, okay, if we were to increase the property tax relief and reduce the net tax rate, what would circuit breaker losses look like then? Because keep in mind, this is how much money they'd be losing each year. So the various bar graphs, the red is if they adopted a 0.25% property tax replacement income tax. So in 2018, you can see their circuit breaker losses would decrease to $427,000 down to $343,000. So that's about an extra $70,000 of additional revenue that they would receive in property taxes if they were to apply this income tax. So this is something that you'd kind of look at to see if it makes sense for you to apply to this tax. The next local income tax is the expenditure rate. Again, it has 4 different buckets: certified shares, public safety, economic development, and the correctional and rehabilitation facilities tax. The allocation to the buckets is determined by percentages established by the county adopting body, either the local income tax council or the county council. For those that have had CAGIT in the past, as you know, part of that revenue first goes to schools. Even with the change in the law and going from the local income tax, that doesn't change. The first 0.25% goes to the schools, and then the remaining goes to the other units. But within the expenditure rate, the certified shares, that bucket, again, that's what we called COID or CAGIT. It can be used for any legally available purpose, so it has the most flexibility. It's distributed to all units that have a property tax except for schools, and can also be allocated to solid waste management if chosen by the approving body. The next line item is public safety, which has we've seen quite a few counties, especially when it first came into law, adopt this public safety. The reason that, again, it's more restricted because it can just be used for public safety. I say restricted, but it's still pretty broad, and we've on the screen have a list of the different types of expenses that the public safety can be used for. But no increase in income tax is popular, but you oftentimes find that it's easier to sell to your constituents that we're increasing this tax for public safety. And that's easier to sell than you're increasing a tax to fund jail or maybe to pay employees. So I think that's one reason why you've seen public safety tax, so many counties adopt that. And even though you're saying you're applying it for public safety, a lot of times your public safety taxes or expenses are being paid out of your general fund. So what you can do is increase your public safety local income tax or adopt one, and then shift expenses out of your general fund to this fund. And so that you don't have such a large burden on your general fund. And that may help you generate that balanced budget. That is what we're trying to accomplish. PSAPs, that's also been popular the last couple of years. Counties like it because the first portion of the PSAP, local income tax, goes to the county before it's distributed to all the other units. So especially as they've combined services, and it's been putting more stress and more responsibility on counties. We have seen more counties adopt this rate, again, because they get the money off the top. Then what's remaining goes to the counties. So this just talks about you can adopt it, whether it's a local income tax council or a county council. And there's a couple different procedures why, but both can be accomplished. And I would not be surprised if I see this occurring more and more, just because cities and towns were kind of hit hard by circuit breaker first because their tax rates were higher. They tend to be higher. Now counties are starting to feel the pinch more and more. And a lot of you have increased the local income tax the last couple of years, and I can see that trend continuing. And the next couple of years, I see counties revisiting, do we need to increase it more? Just because if you did have any balances, you're starting to eat away at those. Economic development, that really hasn't changed over the years. It can still be used for any lawful purpose. Still have to put together a plan in order to receive that money. The only difference between the economic development income tax and the certified shares is that economic development is just the county, city, and town receives those revenues, not townships or libraries. The new tax that came into law a couple years ago was the Correctional and Rehabilitation facilities. Again, it can be adopted by the county council. It can only be used for costs associated with correctional and rehabilitation facilities. And the reason why this income tax came into law is because there are so many, as many of you know, jails are a hot topic right now for many counties. Discussions of either have recently built one, discussions of building one, or in the process of building one. And legislators were, every year more and more counties were coming in front of them for the special tax rates for jails. They thought, well, let's give counties more flexibility and put a rate in the expenditure rate where they get all the revenue. So for this type of rate, you don't have to share, if you increase the rate and adopt this, you don't have to share that revenue with the cities and towns and the townships. You get all that off the top. So it's more efficient. It's because you're funding a project that benefits everyone in the county. I know cities and towns think, well, it's a county jail. But, you know, it's, if you kind of look at probably where most of your inmates are coming from, you might think it's a city jail sometimes. But so that's why the legislature, at least they had some foresight and looked at the county should receive all that money. It's in increments of 0.01%, may not exceed 0.2%. So the drawback on this is 0.2%. The purpose of this is to help fund new jails or renovate existing jails. 0.2% in most counties isn't enough to get the jails that most counties are talking about constructing right now. But at least it might get you part of the way there. The key thing here is when the legislation was first passed, that 0.2%, it could be used for operating or bonds or capital expenditures. They tweaked the law this year and said now if you adopt this tax rate after June 30th, 2019, only up to 20% of what you adopt can be used for operating. The remaining 80% has to be used for capital type expenses. So that's different. So if you're looking at doing this, I know a lot of counties adopted this last year to help pay for operating costs. It wasn't that they were wanting to build a new jail, it was just to help subsidize their general fund because the operating costs for these kind of facilities are increasing. So now only up to 0.2% or 20% of what you adopt or collect can be used for operating. The other thing that changed this year is the tax rate can't be in effect more than 22 years. In the original legislation, it was capped at 20 years. And then the special purpose rate, again, that's you really have to go back to the legislation and talk to your legislators and basically change the law to have a special rate just for your county for your project. And like I said, there's a number of counties, I think 20-some, that have this, and they're specifically really for jails and courthouses. And I think it's going to be harder. Up until a couple years ago, it used to be very hard. You'd have to kind of go to the legislators, kind of make your case, prove that you need the revenue. You've tried everything else, and this was the last resort. Up to about 2 years ago, it was much easier to get a new rate. But now, with that 0.2% in place, I think if you're looking at talking about a jail, I think the legislators are going to look and say, what have you already done? What rates have you already increased? Have you taken advantage of those before they're going to just let you have a special purpose rate? So I know there's a number of counties out there that we're working with and looking at all the different scenarios that you can come up with the fund amount of revenue you need to fund a new jail. And then what we're looking at is this right here. As we talked about the different buckets of this expenditure rate, again, this is the same dollar amount, $600,000, that the county could receive. But depending upon which expenditure rate you choose greatly dictates how much the county will receive. So if you were to adopt, and I can't remember what rate this was, but say it's 0.5% on each case, in certified shares, the county would only receive $418,000, because under certified shares, that $600,000 gets allocated or shared to the other units. If they were to adopt the public safety tax, the county would get $508,000 of the $602,000. And then the last two, if they would adopt the correctional and rehab rate or the special purpose, the county would receive all $600,000. So again, it's kind of important to think about what your purpose is and which rate you choose. As far as the approval process, again, the adopting body votes on the proposed ordinance, have to have a public hearing. DLGF, I know, sends out memos. Fred sends out memos at least once, twice a year with examples of those ordinances. I definitely take advantage of those. They also recommend that you prepare an ordinance and send it to them to review. It takes about 30-day turnaround. But I strongly recommend that too, because the ordinances, they are a little confusing, and it's dependent if it's a local income tax council or a county council. So I strongly recommend you take advantage of what they're offering, fill those out if you're looking at changing your tax rate, and send it to DLGF for their review, and they're happy to do that. You can increase, decrease, rescind a rate, change the allocations. Really a lot of flexibility, but you can only do it one time a year. So working with one county that they made a change very early in the year, they realized that, hey, that's not going to be enough to generate the amount of revenue that we need for this new jail that we'd like to do. So they said, well, let's make another change. Well, it was too late because they already made one change. They got that approved. So they're going to have to wait this year and make that change. So just 1 year. It wasn't that big of a deal. They just had to wait 1 year. But it was just 1 year of revenue that they could have had that they lost. So as you're going through this process, just think about, everything that you may want to do, because if you decide you want to change your mind, you're going to have to wait till the next year to make any changes. The effective rate, or the effective date, I have here. Again, if you want, as you're going through your budget right now and find out that you don't have a balanced budget, that there is a gap and you need some additional revenues, as long as you adopt an ordinance by October 31 of this year, it'll be effective January 1, or you'll start receiving revenues in January 1 of 2020. So if you adopt it between January and August 31 of this year, it becomes effective October 1. So that means that it'll actually start showing up on taking out of people's paychecks in October. But you still won't receive money until January 2020. If you adopt it between September and October of this year, taxpayers won't see a difference in their paycheck until January 1, but you'll still start receiving money in January 1 of 2020. But if you wait till after November 1 to adopt any change in tax rate, that's not going to show up until the following year, 2021. Some of the other things that we've seen counties do, and I think it is a good idea, is maybe you can reduce one income tax and increase another one, so the overall local income tax is the same. So you have a 0.5 edit tax and a 0.5 certified shares. Well, say the county needs more revenue, so let's reduce the certified shares by 0.25 and make that 0.25, but increase the edit by 0.75. Still, you're at 1% either way, but now you're shifting money from some units to other units. Well, that's legally, you can do that as long as those units don't have bonds that are outstanding that are dependent upon that revenue. So as you're looking at, especially reducing revenues, you have to be aware of all the other units and what obligations they have outstanding. But you can't put the bondholders in jeopardy of not getting paid. So any bonds that are outstanding have to have coverage of 1.25%, meaning that the revenue that those units receive has to be able to make that annual payment 1.25 times. So I'm working with some counties. I know that they have reduced some income taxes, and that's something that we've had to work with the other units just to make sure that we weren't putting them in jeopardy of not being able to make any bond payments. So if that's something that your county considers, just be mindful of that. Page 68 again is just kind of things to consider as you're making changes. Careful planning incorporation. And you do have to have a public hearing where all the units are invited to come. I know the county, cities, and towns, you are all in it together, so it is important to have collaboration and input from all the different units. Again, determine what the impact is. You just don't want to be aware of any unintentional consequences. Looking at outstanding debt and how it impacts the other allocation areas. Again, this was just one of the revenues that we looked at, but I think it's one where we're seeing a lot of counties, take a hard look at as an option, and can help you be able to fund that gap and balance your budget if that's kind of where you find yourself, this summer as you're looking through your budget. That's the end of our presentation, but Paige and I'd be happy to answer any questions that you might have. I know we covered a lot of information. I'd be happy to try to answer any questions. I also know it's probably close to 4 o'clock and you're anxious to get out of here, so I don't blame you.
Good job, though.
Well, thank you.